The median American heading into retirement right now has about $185,000 saved. Not the average, the median, the middle of the country. The number that isn't skewed by the guy who sold his tech startup and is now ruining the bell curve for everyone else. $185,000. The average retired worker currently receives $1,975 a month from Social Security as of January 2025. Add 4% off $185,000, which is $7,400 a year, or $617 a month, and you have a retirement income somewhere around $31,000 per year. That is what a lifetime of following conventional financial advice looks like for the median American. And here's the thing that makes this video actually worth watching. If you have any money invested right now, in any account, in any fund, with any consistency at all, there's a genuinely good chance you are already lapping these people and have no idea the race is even running. I am going to show you 3 specific, measurable, verifiable signs that your portfolio is compounding faster than 95% of Americans right now. Not because you are doing anything heroic, possibly because you are doing almost nothing at all. And by the end of this, you are going to understand exactly why doing almost nothing is the most powerful financial strategy most people will never try. There's a scoreboard in every competitive game. Football has a clock. Chess has a board position. Any grandmaster can evaluate in 30 seconds. Even poker has chip counts visible to everyone at the table. Wealth building has a scoreboard too. The thing that makes this particular game genuinely strange is that the scoreboard is invisible. It runs every single day. It updates in real time, and the majority of the people currently winning it have not looked at it in years. The scoreboard does not reward attention. It does not care if you refresh your brokerage app 14 times before noon. It rewards structural position. And that is the concept I'm going to come back to throughout this video. Because each of the 3 signs I am going to show you is really just a different way of asking the same question. Have you positioned yourself correctly and then had the discipline to get out of the way? In a few minutes, I am going to show you something about the behavior gap that your financial advisor will never put in writing for you, because quantifying it would explain why his job does not need to exist. But first, the first sign, and this one is both obvious and wildly underestimated. Sign 1 is this: you are in the market at all, and you have been there long enough to matter. I know that sounds too simple to be the opening move of a serious argument. Stay with me for 60 seconds. If you have any retirement savings whatsoever, you are already ahead of 54% of people who admit to having no retirement savings whatsoever. That is not a figure from some ideologically motivated think tank. That is Federal Reserve data. More than half of American households are sitting at 0, not behind, 0. The starting line of the wealth race has been crossed by fewer people than most of us assume, because everyone we actually talk to about money, friends, colleagues, the people commenting in finance forums, is biased toward the segment of the population that is already engaged with the question. After surging 26.3% in 2023 and 25% in 2024, the S&P 500 followed up with a total return of 17.9% in 2025, capping 3 consecutive years of exceptional performance. 3 consecutive years of double-digit returns. If you had money in a broad index fund at the start of 2023 and you left it there, your portfolio participated in one of the most sustained equity expansions in decades. The people who did not, the 54% with nothing invested, watched their savings accounts pay somewhere between 2 and 4% while that window opened and partly closed. There's a parable that I keep coming back to when I think about this. There was a rice farmer in ancient China who bet his king a seemingly trivial wager: 1 grain of rice on the first square of a chessboard, 2 on the second, 4 on the third, doubling all the way to square 64. The king, not understanding exponential growth, thought he was getting a deal. The farmer knew that by square 64, the king would owe more rice than had ever been harvested on earth. Exponential math does not feel real until you run it long enough to see it. Every year, someone delays entering the market. They are choosing to stay on square 1 while others advance. not by a little, by a geometric gap that widens permanently. Accounts held for 20 years or longer averaged $283,200. According to the Employee Benefit Research Institute, a figure that directly reflects the compounding effect of sustained long-term saving. 20 years of consistency, that is the threshold where the math starts doing the serious work. And the threshold is available to anyone who starts. The average retirement savings for all American families is $333,940. But the median is $87,000. Only 5% of households with retirement accounts have $1 million or more saved. That median, number $87,000, is the actual score of the actual middle of the country. If your current balance is higher than that, you are not in the top half. You are not average. You are in the territory where the scoreboard has already meaningfully separated you from the crowd, and you probably do not know it because nobody told you what the score actually was. The scoreboard is invisible. It does not mean the game is not running. Now, here is where it gets genuinely uncomfortable, and I want you to stay with this one because it has real dollar implications that most people have never actually run the math on. Sign 2, and this is the one that, in my experience running a business and watching money flow through organizations, surprises people more than anything else. Sign 2 is this: your cost structure is already beating the people who think they are investing smart. Most Americans who describe themselves as investors, the ones using a financial advisor, holding actively managed mutual funds, enrolled in a generic workplace 401k that defaulted them into whatever fund lineup was cheapest for the plan administrator to offer, are paying somewhere between 1% and 1.5% per year in fees. Some are paying more, sometimes significantly more, without ever having looked at the line item. Here's what that costs in absolute terms, with no abstraction. Consider two identical $100,000 investments earning 8% annually over 30 years. One charges 0.1% and the other charges 1%. The low-cost fund grows to approximately $983,000, while the high-cost fund reaches only about $761,000, a difference of over $220,000 lost entirely to fees. $220,000, not to a market crash, not to bad luck, not to a global recession or a tariff war or an election outcome, to an annual percentage so small it barely registers when you first read it on a fund prospectus. The mechanism is almost cruel in its elegance. The fee takes a percentage of your growing balance every year, which means it takes more money in dollar terms every year without the percentage ever changing. In year one, a 1% fee on a $100,000 portfolio costs $1,000. The investor notices that the fund charged $1,000 for the year and moves on. In year 15, if the gross return has been 7%, the portfolio has grown to roughly $275,000 before fees. The same 1% now takes $2,750. The percentage stayed the same. The dollar amount nearly tripled. And then that extracted money does not just disappear, it takes with it all the compounding that money would have generated for the next 15, 20, 25 years. A 0.5% fee difference sounds trivial annually, but it costs approximately $59,100 over 20 years and $165,800 over 30 years on a $100,000 initial investment. The gap nearly triples between year 20 and year 30 because the compounding engine has a larger eroding base in later years. The cost of a 1% expense ratio versus 0.1% represents a 22.4% loss of ending wealth after 30 years. 22% of your total ending wealth, not your annual return, your ending wealth, the thing you spent 30 years building. But here is the reversal most people never get to. You think the problem is that you have not found the right fund manager. You think the problem is inadequate talent in your portfolio strategy. You think the solution is more analysis, more research, more active management. The actual problem is that active management starts before the manager makes a single trade, because the fee creates a hurdle that most professionals cannot clear consistently. In 2025, 79% of all active large cap US equity funds underperformed the S&P 500 worse than the 65% rate observed in 2024, and the fourth worst year for active large cap managers in the 25-year history of SPIVA scorecards. After 15 years, there were no categories in which the majority of active managers outperformed. None across domestic equities, international equities, and fixed income. 0 out of 22 categories. And this is after accounting for survivorship bias, meaning the worst performing funds that got quietly folded are included in the data, not erased from it. I had a conversation with one of my accountants a few years back. He told me that the clients he had watched accumulate the most serious wealth over a 30-year career were almost never the ones calling him with questions. They were the ones with a simple structure who had developed an almost pathological indifference to financial news. Not ignorance, not incuriosity, disciplined indifference. The kind of indifference that looks boring from the outside and looks like a 7-figure account statement from the inside. Morningstar's 2024 fee study found that the asset-weighted average expense ratio across all US mutual funds and ETFs fell to 0.34%, saving investors an estimated $5.9 billion compared to the prior year. That industry-wide shift means a large portion of investor dollars have migrated to cheaper vehicles. The investors still holding funds above 1% are now paying roughly 3 times the industry average, and the compounding penalty for that gap accelerates with every passing year. Sign 2 is this: if you are already in a low-cost broad market index fund, if your expense ratio is below 0.1%, you are not just saving money on fees. You are structurally outperforming the majority of the professional management industry by starting the race with less handicap than they impose on themselves. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Knowing these numbers and building a complete system around them are 2 genuinely different things. I had all of this data several years ago. The fee math, the SPIVA results, the compounding tables. What I did not have was a coherent framework that connected the accumulation mechanics to the withdrawal strategy, because the accumulation phase and the withdrawal phase operate under completely different rules, and most people treat them as the same problem. That is what I built in the Exit Code. It is a digital book, 8 chapters, built on 50 years of actual retirement data, not general advice, not generic recommendations that apply to everyone and therefore to no one. A mathematical framework for calculating a specific date when the work becomes optional. 2 things from the book that connect directly to what we just covered. First, there is an entire section on what I call the dynamic withdrawal method, which replaces the 4% rule. The 4% rule was developed in the 90s for a specific set of conditions, a specific portfolio composition, a 30-year horizon, a specific bond-to-equity ratio that bears limited resemblance to what most people are actually building today. It is a blunt instrument applied to a precision problem, and for people planning to retire before 65 or with longer drawdown horizons, it carries meaningful sequence of returns risk that the simple rule completely ignores. The dynamic withdrawal method addresses that gap with a mechanism that adjusts based on actual market conditions rather than applying a fixed percentage to a volatile balance. Second, the book covers the lazy portfolio, the historically validated passive allocation structure that has outperformed the average active trader across every 30-year window in the dataset. Not because it is clever, because it is cheap, consistent, and psychologically manageable, which, as it turns out, matters more over a 30-year horizon than any particular investment insight. The Exit Code is available through the link in the description for less than a dinner out. Every year without this framework compounds against you. That is not a pitch. That is the same math we just walked through on the fee drag calculation. Now, sign 3. This is the one that almost nobody talks about directly, and I think it is worth more than the first 2 combined. There's a gap in financial research called the behavior gap. It refers to the documented difference between the returns that the market produces and the returns that individual investors actually capture. This gap has been tracked for decades. The results are consistent and consistently depressing for everyone who considers themselves an engaged investor. In any given year, the market might produce a 10% return. The average equity fund investor holding the same or similar funds captures somewhere between 5 and 7% of that. The rest evaporates. Not to fees, we already accounted for those. Not to bad fund selection, to behavior. The average investor watches their portfolio drop 20%, feels a physical stress response that their brain is misinterpreting as a threat signal, and sells. Then they wait until things feel safer, which is code for until prices have already recovered and they're buying back at a premium. Then the cycle repeats. Each rotation locks in a small loss at the bottom and a small overpay at the top. Compounded over decades, that is the wealth gap. With dollar cost averaging, investing a set amount at regular intervals ideally automatically allows you to ignore short-term noise in the market and virtually guarantees that you buy more shares when stock prices are low and fewer when they are high. That mechanism sounds simple. It is almost insultingly simple. But the structural power of it is that during every market correction, during every event that generates headlines and fear and the overwhelming human urge to do something the automated investor is buying, not by discipline in the moment, by prior commitment, by the same mechanism that makes payroll deductions so effective, the decision is made before the emotion arrives, so the emotion never gets a vote. In 2025, the S&P 500 dropped meaningfully in the spring, punctuated by the introduction of ultra-high reciprocal tariffs on dozens of countries. Then, the index surged nearly 39% on a total return basis from the April low through year-end, as tariff rates were subsequently lowered via trade deals and a temporary truce with China. The investors who automated their contributions bought shares in April 2025 at the lowest prices of the year. They did not plan to do that. They did not need a brilliant analysis of tariff policy. They did not need to correctly predict the trade deal timing. The automation did it for them. The investors who panicked, who moved to cash in April and moved back in over the summer, bought back at higher prices and missed the most powerful part of the recovery. There is a story that has been floating around finance circles for years, and I cannot verify whether it is literally true or an organizational legend, but Fidelity has allegedly run internal analysis of their best performing client accounts over extended periods, and the portfolios that consistently outperformed belonged to one of two categories. Accounts belonging to people who had died, and accounts belonging to people who had forgotten they had them. The dead investors won. The forgetful ones came in second. This may or may not be a rigorously documented finding. The underlying principle is rigorously documented. Research shows that investors who resist the urge to panic sell during downturns generally achieve better long-term returns. Sign 3 is this: you have automated your contributions and you have stopped watching. Maybe you did it intentionally. Maybe you set up a 401k 12 years ago and never thought about it again. Maybe you are constitutionally unable to care about financial news, which in this context is genuinely an asset. It does not matter why. The scoreboard is running. You are accumulating shares at every price point, including the ones that feel the worst to buy. You are capturing the market return rather than a behavioral discount on it. And you are almost certainly not aware of how large that advantage is. Let me now introduce someone who has been quietly threading through this whole video. Call him David. He is 43, a logistics manager in Ohio, earning about $80,000 a year. He enrolled in his company's 401k 12 years ago because HR told him to. He contributed enough to capture the employer match. He picked a target date fund because it was the simplest option on the list, and he was not sure what the other ones meant. He has not changed anything since. He does not watch finance channels. He does not have a financial advisor. He has no strong opinions about Federal Reserve policy or whether technology stocks are overvalued. He is not what anyone would call a sophisticated investor. Americans in their 40s have a median retirement savings balance of $220,919. David has $260,000 in that account. He is above the median for his age group. He has a low-cost target date fund with an expense ratio around 0.15%. He has automated contributions. He has never once reacted to a market correction. He ticks all three signs without having intended to tick any of them. The scoreboard says he is winning a game he is not aware he is playing. His only serious gap, and I want to be honest about this because it is real, is that he has not thought carefully about the withdrawal phase. He has nailed the accumulation logic almost entirely by accident. What happens when he starts drawing down that account? In what sequence, at what rate, under what market conditions? That is a different and more complicated problem. But that is also a problem most people would love to have. Now, the meta revelation, the thing that makes this genuinely more than the sum of its parts. Each of the three signs we just walked through compounds the others. This is not addition, this is multiplication. Take two investors, both 40 years old, both earning $95,000 a year, both investing $400 a month for the next 25 years at a 7% average gross annual return. Investor one, call her Sarah, is in an index fund at 0.04% expense ratio. She automated contributions a decade ago and has not touched the allocation since. She went through the spring 2025 correction without moving a dollar. Investor two, call him Marcus, holds an actively managed fund at 1.1% annual expense ratio. He is an engaged, attentive investor. He reads the newsletters. He moved 15% of his portfolio to cash in spring 2025 because things felt uncertain. He moved back in 3 months later at higher prices. At the end of 25 years, the combined impact of fee drag and behavior gap, two invisible forces that operate silently in the background, puts Sarah's final portfolio somewhere around $580,000 and Marcus's at roughly $360,000 to $380,000. Same income, same monthly contribution, same basic market environment. A gap of approximately $200,000 from three structural decisions that Sarah made once and never revisited. Federal Reserve data shows that the richest 10% of American households now own over 2/3 of the nation's total wealth. The assumption most people make is that this is explained entirely by income differences. Higher earners invest more money. Of course, they end up with more. But the data on cost structures, behavior gaps, and time in market suggests the real explanation is more mechanical than that. The top decile is not 10 times smarter than the median. In many cases, they simply access the same market returns at lower costs with more consistency for longer, without allowing the emotional feedback loop to interrupt the compounding. About 3 in 5 American workers, 58%, say their retirement savings are behind where they should be. Of those, 37% say they are significantly behind. 58% of the country is operating from a feeling of being behind. And feelings of being behind are not neutral psychological states. They produce behavior. They produce the chasing of higher returns. The switching to the hotter fund. The gambling on assets that promise to close the gap quickly. The decisions that systematically make the problem worse. The most dangerous financial emotion is not fear. Fear makes you hold cash and miss gains. The most dangerous financial emotion is the chronic sense of being behind because it manufactures urgency in a game where urgency is the enemy. And here is the final kicker, the thing I want to leave you with as the engine that runs this entire dynamic. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. The median person near retirement has $185,000. That gap is real and it is large, but the mechanism that produces it is not mysterious or conspiratorial or the result of some systemic unfairness that cannot be addressed. The mechanism is 3 things: starting late or not starting at all, paying too much in fees, and making reactive behavioral decisions that subtract real percentage points from actual returns. 3 things, each of which is directly addressed by the 3 signs we just walked through. The scoreboard is invisible, but it is not unknowable. 3 takeaways: specific, not generic. First, open every investment account you hold and locate the expense ratio of every fund. If any fund in your portfolio shows an expense ratio above 0.2% for a passive vehicle, you have found a fee leak. The asset-weighted average expense ratio for equity mutual funds fell to 0.40% in 2024, but the unweighted average remains 1.10%, meaning expensive funds persist even as the industry overall has gotten cheaper. The investors still in those expensive funds are paying a compounding tax on the gap that grows with every passing year. Second, find the Federal Reserve's median retirement savings data for your age cohort and compare your current balance against it. Americans in their 30s have a median retirement savings balance of $98,952. Americans in their 40s have a median of $220,919. Americans in their 50s have a median of $460,363. If you are above your age cohort's median, you are already winning the comparison you did not know you were making. That recognition is not vanity. It is an anchor against the feeling of being behind, and it stops you from making panic-driven decisions based on a false premise. Third, identify one contribution that is currently manual and automate it today, not tomorrow. Dollar cost averaging curbs emotional decision-making, reduces remorse after market drops, and gets investors into the market. If your 401k has an auto-escalation feature, where your contribution percentage increases by 1% each year, automatically turn it on. You are not removing discipline. You are removing your present emotional state from a decision that should only need to be made once. David in Ohio is going to look at his account at 55 and find a number that surprises him. He is going to wonder why he does not feel like he did anything. That is the point. The game rewards structural position, not active participation. The scoreboard runs whether you are watching it or not. Lazy investing built more fortune than crypto memes. The system does not require genius. It does not require perfect timing. It does not require a financial advisor who calls you every quarter to tell you that things are looking good. It requires 3 boring structural decisions, made once, maintained with the specific discipline of not undoing them when the headlines get loud. That is the whole game. That is the sign you are already winning.